Hello, today we will talk about post-balance sheet events and reporting.
During completing the audit, auditors should consider whether the information presented and the accounting policies is compliance with Accounting Standard and Companies Act 1965. While registered companies to table its annual financial statement at AGM at least once in every calendar year at interval not more than 15 months. Next is accounting standard that auditor need to follow, which is FRS 101 presentation of financial statements, FRS 110 event after the balance sheet date, FRS 124 related party disclosure, and FRS 137 provision contingent liabilities and contingent assets. Analytical procedure usually apply at or near the end of audit when forming an overall conclusion as whether the financial statements are consistent with auditor's knowledge business. Intend to reconfirm with the conclusion made during audit of individual account balance. Substantive test mean auditor concludes that account receivable is fairly stated. When the analytical procedure on account is performed and if the result also conclude is fairly stated, looks like the conclusion need to be reconfirmed and it can be basis for auditor's opinion. Type of post-balance sheet event can divide into adjusting after reporting date, which contain of 1. The settlement of legal claim outstanding at reporting date. Example, when in lawsuit settlement during December 20, 2015 which begin 2013, occur before balances date, December 2016. Financial statement is adjusted to of current period income and not prior period adjustment. 2. Declaration of bankruptcy by clients. Example, when a company declare bankruptcy occur February 1, 2016. This required clients to recall the December 31, 2015. The uncollectible amount was determined before end of the field work. 3. Is as an adjusting event after reporting date. 3. Disposal of equipment. Example, disposal of machinery at RM 10,000 while current value is RM 20,000. Since it is occur after the ending of balance sheet date but before audit report date, auditor should adjust it during December 31, 2016, while non-adjusting event after reporting date is investment market value had declined. Example, only disclose the nature of the event, estimate the financial effect or a statement that such an estimate cannot be made on the footnote of our auditor financial statement for the particular clients. Next is business combination. Example, MFRS 3 business combination last 2 months after the closing of financial statement. Adjust under footnote because it is under MFRS 3 cases, then is event after reporting period MFRS 10 which is commerce major litigation arising solely out of events that occur after last year accounting date. Disclose it at the footnote about its nature and state an estimate. Example, purchase major asset and commerce major restructuring after reporting date.
Going concern. It requires the auditor to assess the risk of going concern problems at the planning stage and again during the final review. Next, there is an important assumption underlying the preparation of financial statements. Under going concern assumption, an entity is assumed to be able to continue as a going concern for a foreseeable future period of a time. Next is the auditor's responsibility in going concern. First, they must consider the appropriateness of the management's use of the going concern assumption in the preparation of financial statements. And the second one is, they must alert whenever there are any material uncertainties about the entity's ability to continue as a going concern. Next, there are several indications that auditor need to be alert for the going problem, which is: first, operating indications. For example, shortage of important supplies, loss of management personnel. Second, financial indications. For example, inability to obtain financing, adverse key financial ratio. And third, other indications. For example, pending legal proceedings against the entity. Next, the steps to be taken by auditors. First, evaluate whether the results of audit procedures performed. Second, the auditor should obtain information about the management's plan. Third, The auditor consider the adequacy of the disclosures with respect. Mitigating factors. Factors or situation where auditor can satisfy with, for example. First, for indications liabilities exceed assets. May be mitigated by management's plan to maintain adequate cash by disposal of assets or confirmation for financial report. Second, for indication loss of principal. May be mitigated by availability of source of supply. So the availability of stocks enable the company to still in operation at least in the next 12 months. Contingent liabilities. The definition is a potential future obligation to an outside party for an unknown amount arising from activities that have already taken place. There is have a two type of liabilities, which is first, a possible liabilities that arise from the past events and the evidence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not within the control of the entity. There might be a risk that they will not be completely and properly disclosed. Second, a present liabilities that arise from past events, but is not recognized as a liability. The preset obligation is not probable and cannot be reliably measured. Next, audit procedures to identify contingent liability. First, read the minutes of meetings, BOD, shareholders. Second, review contracts, loan agreements, leases and correspondence. Third, review income tax liability, tax return. Lastly, impact other documents for possible guarantees, commitments. The definition is an agreement to commit the entity to a set of fixed condition in the future, regardless of what happens to profits or the economy as a whole. Often enter into long-term contractual commitments to acquire capital assets such as plant and machinery or to sell their products at a fixed price. Long-term commitments are usually identified through inquiry of management and other entity personnel during the audit of the revenue and purchasing processes. Such commitments are disclosed in the notes to the financial statements. Importance of commitment. It represents the conditions of potentially material amounts of resources that may be utilized during future periods, then it will affect the future cash flows available to creditors and investors. Type of evidence of commitment. First, inquiry from the management. For example, ask commitment or obtain letter of representation. Second, documentation. For example, read minutes such as director or committee's meeting.
Now we talk about audit of accounting estimates based on ISA 540. Based on ISA 540. Auditors should obtain evidence regarding accounting estimates, which mean the allowance to reduce inventory and receivable to their estimated realizable value, the depreciation or amortization, accrued revenue, deferred tax, provision for loss from lawsuit and provision to meet warranty claim. Audit procedures. Auditors should review and testing the process used by management by evaluated data and consider of assumption used. For example, estimating account receivable. Review aging and consider the accounting policies for doubtful debt. Specific provision or general. Next, auditor should testing the calculation and compare the estimate of current period to last period. Auditor also need to review subsequent events. This because subsequent event may provide audit evidence regarding the accounting estimate made by management. For example, is bankrupt of a customer and inventory damages caused by fire. Now let's talk about related party transaction based on ISA 550. Based on ISA 550. Auditors should perform audit procedures in order to obtain audit evidence regarding related parties' transactions and the effect on the financial statement. Example of related party transaction. 1. Purchase or sales goods. 2. Purchase or sales property and other capital asset. 3. Transfer under license agreement. 4. Leasing and rental agreement. 5. financial arrangements such as loans and equity contribution in cash or in kind. 6. Rendering and receiving services such as management services. Audit procedures. Auditor need to review last year working paper for identify related parties and their transaction. Next, auditor should review the minutes, corporate structure and discuss with management. Auditor also need to make the confirmation with related parties, the terms and the amount of the transaction. Auditor must check the documentary evidence that related party have and keep. Auditor should have the representation letter by the management that concerning the completeness of information and the adequacy of the related party disclosures in the financial statement. Next is document and completing the audit, which is covered in ISA 580. According to ISA 580, management representation letter defined as a letter from the management to confirm to the auditor that all information, in all material respect, has been properly disclosed in the financial statement and to be dated in the same day the financial statement is approved. Scope of ISA 580. 1. ISA 580 requires the auditor to obtain appropriate representations from management, which may be oral or written. 2. An auditor is responsible to obtain representation letter from management and where appropriate, those charged with governance in an audit of financial statements. 3. Written representation letter can be categorized as audit evidence, which is the information used by the auditor in arriving at the conclusions on which the auditor's opinion is based. The important purpose of management letter. 1. Acknowledgement by the management of its responsibility for the financial statements. 2. Representation by the management as audit evidence. 3. To conform the oral representation, documented the oral representation. What happen if the management refused to sign the management letter? If the management refused to sign the letter, the auditor should constitute a scope limitation, issue a qualified report or disclaim an opinion. Next is finalizing the audit. Finalizing and other documents, which is making an overall final review by audit manager and partner on financial statement and should give a reasonable basis for audit opinion. In management letter, auditor shall include any advice about the weaknesses of internal control that found during the field audit work. List of outstanding matters. 1. Confirmation on directors' shareholding and remuneration, in this form of letter, which is need to be signed by the director itself. 2. Other outstanding matters such as confirmation letter to the creditor and debtor.
Audit report. There have two type of audit report, which is: first, unmodified auditor's report. Second, modified auditor's report. Unmodified auditor's report. Element of the standard unmodified audit report. Report title. Addressee. Introductory paragraph. Director's responsibility paragraph. And etc. Conditions for unmodified audit report. All statement. Approved auditing standards. Standards of audit field work for the understand the entity and its environment and sufficient appropriate audit evidence. Approved financial reporting standard must based on the true and fair view. Unmodified auditor's report with emphasis of the matter. Explanatory paragraph is added to highlight a matter which is included in the note to the financial statement. The note that auditor use for reference to in the report has been properly presented or disclosed in accordance to approved accounting standards. Modified auditor's report. Circumstances. Inability to obtain sufficient appropriate audit evidence, such as lack of audit evidence and auditor inability to obtain the information or the explanations that are considered necessary. Financial statements are materially misstated, such as non-compliance with approved accounting standards and auditor disagrees with management. Next. The material. Qualified, except for either due to limitation on scope or disagreement. Auditor must ensure that the opinion that the overall financial statement give a true and fair view, material and pervasive. First. Disclaimer. This because due to limitation on the scope, auditor has not been able to obtain sufficient appropriate evidence to form an opinion on the overall financial statements. Second. Adverse. Due to disagreement, auditor is of the opinion that the financial statement as a whole is misleading, hence do not give a true and fair view in accordance with the standard. Definition of key audit matter is: auditor's professional judgment of most significance in the audit statement which is selected from communicated with those charged with governance. Those charged with governance is a person with responsibility for overseeing the strategic direction and the financial reporting process of the entity. Matters to be communicated with those charged with governance. First, is the responsibilities of the auditor in relation to the financial statement audit. Second is planned audit scope including the significant risks identified by the auditor and timing of the audit. Third, the auditor's view about the accounting policies, estimates and financial statement disclosures. After that is significant difficulties encountered in obtaining audit evidence, significant deficiencies in internal control, and lastly, is auditor independence. Nature of key audit matters. Areas identified as significant risk. Significant auditor judgment. Encountered significant difficulty. Matters that require significant hour by engagement partner. Involve consultation. Evaluation the engagement quality control reviewer. Accounting estimates with high estimation uncertainty. Significant transaction with related parties. Limitation on group audit. Extensive unexpected effort to obtain sufficient appropriate audit evidence. And lastly, is recent economic, accounting, regulatory and other development, determining key audit matters. 1. All matters communicated with those charged with governance. 2. The determination of the matters that required significant auditor attention in performing the audit. 3. The determination of which of those matters were most significant. And 4. Permission to carve out sensitive matters. Number of key audit matters in the audit report. 1. Size and complexity of the entity. 2. Nature of its business and environment. 3. Facts and circumstances of the audit engagement. 4. ISA 701 does not prescribe the number of key audit matters that should be reported. And 5. Key audit matters are selected based on the auditor's professional judgment. Communicating key audit matter. Limiting the use of highly technical auditing terms. Auditor to avoid giving original information. Reference is made to relevant disclosures in the financial statements. The auditor describes its effect on the audit. Procedures performed described at a high level and not a detailed description of procedures. Address the specific outcome but avoid the impression that an opinion express on individual matters, describing key audit matters in the audit report. Why the matter is considered to be of the most significance. Reference to related disclosures. How the matter was addressed in the audit. Brief overview of procedures performed. Key observation or indication of the outcome of the procedures. Top 5 key audit matter most reported case. Impairment of assets. Tax. Goodwill impairment. Management override of controls. And fraud in revenue recognition.